Hey everyone, it's Shauna the Tax Goddess, and today I am here with one of my favorite specialists. His name is Trent Lee, and he is a specialist in business valuation for businesses that are looking to sell. And I have a million and one questions. Trent, how are you doing today?
Good. I'm happy to be here.
We're happy to have you. This is probably one of the most requested topics that we get is, Shauna, I've built up this business and now I'm working towards selling it or turning it into a cash cow, but I really want that maximum value. How can I increase that maximum value? Now, I think we need to back up here a step. Trent, what is a business valuation?
Yeah, that's great. Let's start with the basics. So, when I go in and meet with business owners, there's two types of valuations I'm primarily looking at. One is an asset value, and one is what's called a going concern valuation. What we really want is a going concern valuation. Asset value, no one really cares about asset value, but it's relevant in case there's more assets in the business than there is from a multiple of earnings standpoint. So we want to look at it and just be aware of it. But let's focus primarily on a going concern valuation, how it works, what someone can do to get a real rough estimate of how to value their business, and maybe even calculate that a little bit, just kind of back of the napkin math for them. That'll be helpful.
It's a good place to start, especially if you're just thinking about selling your business. How do you even know what it's worth?
Yep, exactly. And that really is the key is they have to get a pretty good idea of what the business is worth if they're thinking about selling it, because they can't make an informed decision unless they generally know what numbers they're working with. So
Yeah.
this will give them a good foundation.
Love it. Okay, so how do we do back of the napkin calculations? How does that work?
All right, so let's start just high level. Primarily, when a bank or a buyer is looking at buying a business, they are looking at a multiple of earnings approach, or what is called a going concern valuation. So what we look at is the bottom line net profit of a business. So I'll start with the tax returns or the profit and loss statement, and I'll look at the bottom line net profit. Now, here's the key. A lot of people, they're right as a business owner, they don't want to show that much net profit because they don't want to, pay a lot
I
of
was just
taxes.
about to ask. The entire job of tax goddess is to make you look like you
Yes.
have no net profit. So how does that work?
Yeah, so it's called recasting the financials. Add backs, adjustments, normalizing the financials all mean basically the same thing. So let's just go with me this made up example, and we'll run through some high level numbers. So let's say there's a business that is doing $6 million revenue, gross top line revenue,
Okay.
and there's $500,000 of profit on the bottom line, right? Maybe that's high, maybe that's low, but for the sake of easy math, we'll go with it. Now, what we need to do is we need to identify what sort of adjustments or add backs that we can justify. And we can, from a defensibility standpoint, we can add back. And those are fairly simple. We can add back depreciation, amortization, non cash related expenses. We can add back owner's wages, and we can add back any type of discretionary expenses. Discretionary expenses meaning anything that's not necessarily relevant to operate the business, but might be a legitimate business write off. So, family health insurance, right? HSA. You and I, when we met in Arizona, we talked. I heard you talk about the HSA accounts. We can add back those type of expenses, and we can calculate what's called seller's discretionary earnings.
I was about to
So
say,
we,
like paying the kids, writing off the dogs, the master's
Mhm.
exemptions, our 831B insurance premiums, all the things
All
that a
of that
good
stuff.
business owner should be doing, we can add
Yep.
back.
We
Okay.
can add
Okay.
back
Okay.
all of that. So here's the key. We want to make sure you get with someone like you, Shauna, that can add back, or that can really, from a tax standpoint, properly document these type of adjustments and deductions. Don't take your family to Disneyland and call it advertising and throw it in the cost of goods, because I can't do anything with that, right? But if you pay your kids on salary and you have all these other things, and maybe those expenses are paying for some additional benefits, well, that I've got a clean line item on my tax returns, on my P&L statement. I can add that back, and we can get the benefit from the tax write-off and the valuation at the same time.
Gotta love some double dipping on that. That's
Yes.
awesome.
Yeah,
Okay. All right. So
exactly.
we've added all this back. What's next?
Yeah, so let's to that made up example, that $6 million top line revenue, $500,000 bottom line net profit. Let's say the owner's paying himself $250,000 in wages, plus there's some depreciation, maybe there's some interest, maybe there's some owner's benefits, health insurance, that type of stuff of another $250,000. So that gets us to $1 million, what's called seller's discretionary earnings. That's important because businesses, from a going concern valuation standpoint, sell for a multiple of earnings. So what we're looking at is we're looking at a multiple of seller's discretionary earnings and a multiple of EBITDA. And just so we know the difference, EBITDA is in this case $750,000 because we take the $500,000 plus the adjustments less the owner's salary of $250,000. So we've got $1 million of seller's discretionary earnings. We've got $750,000 of EBITDA. Both of those have a market multiple. And this is where it's key. Just like a real estate agent would look at houses that are similar in size, area, nature, what have they sold for from a sales comparable standpoint? I have access to a database where I can look up transactions all over the country that have actually closed, and I'm looking for what have they sold for from a multiple of earnings standpoint. So in this made up example, we've got $1 million seller's discretionary earnings. Let's say the market multiple on that is 3.5. And let's say the market multiple on EBITDA of $750,000 is a multiple of 5. So what we do is we take both of those and we then average them together. So a seller's discretionary earnings multiple, $3 million times 3.5 would be a $3.5 million valuation.
Okay.
We take a market multiple of 5 times EBITDA of $750,000, and that gets us a 3.75 valuation, 3.5, right? And then
Yeah.
that gives us a general ballpark that we're right in the right general range. And then we look at averaging those two. So really quick, back of the napkin math is you can take your net profit plus your add backs, reasonable add backs that you've guided them
Can
through.
line item. We got a line
Yeah.
item, guys. Documentation is key. I love it. Okay.
Yeah. And then we just simply take a market multiple. Now it's key. Every industry has a different market multiple. So they want to get with someone, a business broker, a business appraiser that can look up based on their industry. Is the market multiple, in this case, this made up example, we used 5 times the EBITDA. Is that relevant for their industry? It might be higher, it might be lower, but that'll give them a really good feel for how to calculate roughly the valuation. And the 3.5 SDE, 5 EBITDA valuation, that's a pretty safe, generic, general average.
I was just about to say, because you, Trent, being the amazing person you are, you have access to the special database, right? But the rest of us do not have access to the special database. So because we hear this a lot, like it's multiple times 3. So if they go with 3, you're saying that's a good average. Are there any industries where it's normally significantly higher or normally significantly lower?
Yeah, for sure. If there's reoccurring revenue, there's contractual revenue, that will boost the multiple up. So you take a software company, a SaaS company, there's some type of reoccurring monthly, annual contractual revenue. Essentially, think about it from a buyer standpoint. What they're buying is they're buying future income based on historical performance. So if you have a historical performance of reoccurring revenue rather than a construction company that's just one-time jobs, as a made-up example, you're going to get a higher multiple on it, which then affects the valuation. So absolutely.
Got it. Okay.
Yeah.
So what are some of the pitfalls that an unknowing business owner, they're hearing you, they're going, okay, 3 times, I don't have any recurring revenue, so maybe I go with 2 times, right? What are some of the big pitfalls that you see where people really make a mess of it?
Yeah, so mess is the key word. Messy financials is by far the biggest pitfall, right? If they're trying to do their own financials, they're trying to do their own bookkeeping, their day-to-day running the business, and then bookkeeping is an afterthought. It's not accurate, it's sloppy, it's inaccurate. They've got a bunch of personal expenses in there. That is the single biggest deal killer, because if you think about it, it not only kills their valuation, but it kills the ability of a bank. Take the SBA, which is most buyers are going to use an SBA to acquire a business. It kills the ability of the SBA to finance that transaction. And so now we have a business that has sloppy financials. It's not fundable through a bank. And we have to go to the market to try and find someone who has whatever, $1 million cash in their bank account, rather than a buyer who has 10% down with the SBA. It really, sloppy financials, inaccurate financials make a big impact.
Okay. All right. Well,
Yeah.
and of course,
And
we love great financials too.
yeah.
Yeah.
And in fact, let's just kind of bring that point home a little bit and use real life examples. So let's say, and I'll give you I hinted at this before, taking the family to Disneyland and calling it advertising. That was a real life example from a client that I had a little bit ago. And let me just walk you through the math. Now that you understand how a multiple of earnings work, let's see how that affects the valuation on the tax savings versus the valuation. So this family took a all expense paid trip to Disneyland. It was, I guess Disney's got this place in Hawaii, super expensive, nice island, $25,000. They paid for it through the business. They wrote it off incorrectly. And think about it now. If they were paying 25% in taxes, right? So yeah, it saved them a few $1,000s in taxes.
$62.50. Yep.
Yeah, but think about what it costs them in valuation. If we apply just for the sake of easy math, a 3 multiple on that $25,000, while it saved them $6,000 in taxes, it costs them $75,000 in valuation. It's just, so whatever you do, get good, clean, accurate financials, categorize them right. You will make up for it 10 times over when you sell the business, rather than just kind of sloppily throwing it in there.
So let me ask you this question, right? How far back does the SBA or banks or anyone look at financial statements, right? Because if I believe I'm going to sell tomorrow, I better make sure my financials are good. But do I need to go back 1 year, 2 years, 3 years? Like, when do I have to start preparing good looking financial statements?
Yeah, good question. So let me tell you, ideally, and then there's often the real world, which is, hey, health issue came up, they're burned out, they just got to sell. So the reality is we can work with anyone, no matter where they're at. But if in the ideal situation, someone wanted to really prepare, what I'm looking for traditionally is a 3-year weighted average if revenue is stable or trending up. Now that's important because I'm going to take a weighted average over the last 3 years to try and average it out. One good year, one bad year is not going to make or break it. And by the way, COVID is not going to make or break it. We're going to kind of toss that out because it was an abnormal year. But if revenue is trending down, the bank, a buyer, an appraiser, myself, we're going to look at the trailing 12 months. So whatever you do, when it's time to sell the business, don't keep it so long that you start burning yourself out and the revenue's trending down, because then I'm looking at 100% weight on the trailing 12 months rather than averaging out a 3-year period of time.
Okay, so huge tip. If you guys didn't hear that in full, right? Don't let yourself burn out. If the numbers are going down, stop the bleeding as quickly as possible. Try and at least keep it stable, because then we can look at 3 years versus the last 12 months. So
exactly.
All right. Okay.
Yeah.
So besides messy financials, what other things ruin a deal?
So I'll tell you something that helps a deal, and we can talk about some things that ruin a deal. But something that helps the deal is to not have one source of revenue. We hinted about this a little bit, of having reoccurring revenue, but not necessarily one source either. If you've got one vendor or one customer that's overly concentrated, bringing in too much revenue, if you've got only one source of income rather than multiple sources of income, That will help strengthen the deal. Now, to your question, some things that can ruin a deal is not being prepared for having proper documentation in the due diligence period. So we need good, clean, accurate financials to value the business properly. But what happens when we take it to market and we find a buyer? The buyer makes an offer, we open escrow, there's an earnest money deposit. The first thing they want to do is they're going to hire a team on their end to help them through the due diligence. And we have to have good, clean documents to validate and verify the income, the expenses, the operations, the payroll, bank statements,
So
all of
Trent,
that.
you're saying don't just go into the books and say I make $1 million. Like you actually have to be making $1 million, right? Is that
You
what we're saying?
actually do. Yes, imagine that.
Crazy. Okay. Well, and so, one of the questions that we get asked all the time is my business too small to sell? Can you
Mhm.
speak a little bit to that?
Yeah, so this is interesting because there are certain business brokers that get really picky. Oh, that business is too small. It's too small for them to sell, but it's not too small to sell. I really enjoy handling the smaller transactions because there's a real need for it. What I try and do is I take the bigger M&A space mentality, the pitch decks, the marketing, the valuation, and I apply it in the small business space. And so I've sold businesses that are very, very small. In fact, I'll give you an example. This is an extreme example. This is not common, but literally on Friday, just a couple of days ago, I sold a business for $1. Now, here's the key. They had to come out of pocket to pay my fee and the other closing fees, but it was five Fantastic Sams, if you're familiar with the haircutting franchise.
No.
It's like a Supercuts or a Sports Clips, that type of a, kind of a in the anchor store franchise that does haircuts.
Okay.
Now, it was losing money. Now, there's asset value there, but there's never too small to sell because in this case the sellers had five locations where they had a personal guarantee on five leases. They had a franchise agreement that had liability to it, and so they were happy to get rid of it for next to nothing. Literally, they had to pay to sell it because they got out of the liability of five leases. They got out of the business that was costing them money.
Yep.
Long story short, why they needed to get out of it. But we found another owner operator that could take on these businesses. It was a great deal for them. They took on the liability of the franchise, they took on the liability of the leases, they were all assigned to them. And so there's never a business that's too small because it either has asset value or it has value from a multiple of earnings standpoint. And there's sometimes real liability that a seller needs to get out of the business for. They might not be selling it for top dollar, but
Yeah.
they're selling it to get out of the
Personal
liability.
guarantees. That's huge.
Yeah, they're selling it to maybe there's a medical issue. Maybe they care about the employees and they want to see the brand and the employees and the customers continue on. And so they might not be getting top dollar for it, but it's still a sellable business.
Very cool. Well, so
Yeah.
you've just led me down an entirely different set of questioning. Here, you mentioned COVID earlier, right?
Mhm.
So many businesses took out EIDL loans, and
Mhm.
if it was less than the $150,000 limit, there was no personal guarantee. If it was more than that, personal guarantees. So, how many businesses are you seeing now trying to be sold? Like, does the EIDL go with it from the SBA? How does that work?
Yeah, that's a good question. So the EIDL traditionally is not transferable or assumable to a new buyer. That's right now. I've done six or seven, no, it's been probably more than that, eight or nine, where we were able to get the SBA to transfer the EIDL to the buyer, and they took on full liability. The SBA is really not cooperating very quickly with us on those type of things, and it's become
Yeah.
a challenge.
Yeah.
So right now, at least in this current state, most of those EIDL loans need to be paid off through the proceeds. It doesn't mean they have to pay them off before escrow. In fact, I'm going through a deal right now, $2.2 million. We're closing on it in 2 days, and there's a loan that has to be paid off, an EIDL loan. We're not asking the seller to write a check and pay it off. but out of the proceeds of escrow that come in from the buyer, escrow will pay off the EIDL loan.
Very
So
cool.
right now, that's where the current environment is. It's changed. We've done plenty of them that were transferable, but not right now. We're not getting a lot of success with that.
Well, and I was going to say, typical traditional government, I'm sure they are a little bit further behind of what's actually happening, feet on the ground.
Yeah.
You know, Trent, my goodness, I feel like I could talk to you for another hour. And so I think I have an odd feeling we're going to have to do a part 2 here.
We'll do this again.
Yes, because we didn't even get to some of the important things, like the documents you need to be able to plan. We didn't even get to these. So Trent, would you mind coming back for a part 2 as another guest?
Yeah, you got it.
Yay! All right. Well, guys, if you are here listening today, Trent, where can people find you if they're thinking about selling a business or even buying a business from that standpoint?
Yeah, absolutely. So my cell phone number, 702-505-2789. My email address is trent@fcbb.com. It stands for First Choice Business Brokers.com. They can reach out. Here's the great thing about how I work. I really try and make it as a no-brainer for sellers to go through the process with me. I'm licensed as a business appraiser. I will do a free business appraisal. We'll take it to market. I'll never ask them for a dime up front. No marketing fees, no monthly fees. I only get paid if and when I do what I say I can do, which is actually sell their business.
Trent, this is exactly why we have you as a member of the Tax Goddess family, right? We love people that put value first for the clients. So
Thanks.
thank you so much for being here, Trent. I can't wait for part 2. And for all of you out there, if you are looking for business sales, call Trent. And of course, today is December 12th. You have about 10 days to do anything else you're going to do about tax strategy. So if you need tax strategy, reach out to the team. Trent, it has been a pleasure. I can't wait for part 2. Everybody out there, have a wonderful set of holidays, and we'll see you in the new year. Thanks. Everybody.
Take care. Have a good one.
Bye.
Bye.